Welcome to the deep dive. If you're prepping for a major strategic meeting on energy markets, or maybe you're trying to catch up on the latest shifts in North American infrastructure.
Or if you're just insanely curious about how the literal gears of the global economy turn behind the scenes.
Exactly, you're in the exact right place. We've got a really fascinating one for you today. We are looking at a company that is quite literally laying down the steel framework for the future of the North American economy.
It's a phenomenal case study. We are digging deep into Pembina Pipeline Corporation today.
Yeah.
We're pulling directly from their Q4 2025 earnings press release and the accompanying earnings call transcript. Both of these are hot off the presses from late February 2026.
And the mission for this deep dive is to cut through the standard financial jargon. We want to understand a very specific dynamic here. We need to figure out how a massive midstream company manages to balance record physical volumes of energy with some very real fluctuating financial headwinds in the markets.
Right.
And more importantly, how they aren't just maintaining their current footprint, but aggressively building out the future of energy export and, surprisingly, electricity.
That is the real story hidden in the numbers. There's always a lot of noise in an earnings report.
Oh, yeah.
Especially a Q4 report, right?
Yeah.
Because it wraps up an entire year. My goal today is to synthesize that raw data.
The capacity metrics, the CapEx.
Exactly. Synthesize all of that into the meaningful trends that are actually impacting the broader market. We want to translate the spreadsheet into the physical reality of what is happening on the ground.
Okay, let's unpack this. I want to start with what feels like a massive paradox right in the middle of Pembina's fourth quarter.
Let's hear it.
When I was looking at the full year of 2025, the physical reality of the business was just booming. I mean, they hit record annual volumes across their pipelines and facilities.
Yeah, massive numbers.
We are talking 3.7 million barrels of oil equivalent per day. That's a solid 3% increase over 2024. The full-year earnings were strong, CAD 1.694 billion, and their full-year adjusted EBITDA hit an impressive CAD 4.289 billion. It paints a picture of a company just firing on all cylinders.
Those are undeniably strong full-year numbers. It shows the physical system is highly utilized, the steel in the ground is moving more product than ever before.
But then, and this is the paradox, but then you look at just the fourth quarter of 2025.
Yeah, it becomes glaringly obvious.
The market reaction felt incredibly harsh. Q4 adjusted EBITDA fell roughly 14% year over year, down to CAD 1.075 billion. And the revenue miss was significant. They posted actual revenue of $1.02 billion. Wall Street was expecting $1.41 billion. So why did the market punish them when their physical volume was actually at a record high? It feels like two completely different realities.
It does feel disconnected. But it comes down to the mechanics of how they actually monetize that volume. The causes of this Q4 dip are multifaceted. First, we have narrower NGL frac spreads.
Natural gas liquids.
Right. For those tracking the commodities markets, the margin between the cost of the raw natural gas and the selling price of the extracted liquids, things like propane and butane, that margin shrank considerably during that window.
And during the earnings call, management specifically called out extreme U.S. weather, right? Driving up Chicago gas prices in the first 45 days of the year.
Exactly.
Which completely squeezed their marketing margins.
That weather volatility is a perfect example of a headwind they can't control but have to absorb. The second major factor hitting Q4 was lower realized gains on crude oil derivative.
The financial hedges.
Yeah. The financial instruments they used to hedge against price drops didn't pay out as much. Volumes in that specific hedging window were lower, and the price spreads were narrower.
Okay, what else?
Then you have a structural change on the Canadian portion of their Alliance pipeline. They implemented a new toll structure and a revenue-sharing mechanism following a recent settlement with shippers.
Ah, so lower tolls.
Right, which meant lower long-term firm tolls in that specific quarter. And finally, they were facing really tough year-over-year comparisons. 2024 had period-specific capital recoveries that bumped up the previous year's Q4 numbers.
Which obviously didn't repeat in 2025.
Exactly.
Thinking about this, it's like owning a vital toll road.
Okay, I like where this is going.
Let's say traffic on your toll road hits an all-time high. That's Pembina's record 3.7 million barrels a day. But because you recently renegotiated the price of the tolls with the major trucking companies, and the cost of maintaining your roadside diners wildly fluctuated because a blizzard hit Chicago, you actually walked away with slightly less cash in that final quarter, even though more cars drove on your road than ever before in history.
That analogy perfectly captures the dynamic.
Yeah.
The underlying asset is highly utilized. But the margins on that utilization were temporarily compressed by external factors and planned structural toll changes.
Right.
However, the executive team made it very clear on the call that they view this as a momentary blip. It's not a long-term trend.
Because their 2026 guidance remains remarkably strong, targeting an adjusted EBITDA of CAD 4.125 to 4.425 billion.
Exactly, which implies a really solid compound annual growth rate on their fee-based business if you track it back from 2023. It shows the core engine is still growing.
And we also need to look at how they're financing that growth, specifically their leverage strategy.
Yeah, the debt. They noted that their debt-to-adjusted EBITDA ratio will peak at roughly 3.7 to 4.0 times in 2026.
Which is a bit higher than normal for them.
It is slightly higher than their historical comfort zone, but it is entirely by design. 2026 is their peak capital investment year for massive projects, particularly the Cedar LNG facility.
Build now, pay it down later.
Exactly. Once those investments are in the ground and the heavy spending ramps down, they expect that leverage ratio to pull right back down into their target range of 3.5 to 4.25 times. They are borrowing to build the future, knowing the cash flow will catch up.
It makes complete sense that their leverage will spike while they build out something as massive as Cedar LNG. But speaking of building things out, you can't look at Pembina without looking at what they're physically putting in the ground right now.
Especially in Western Canada.
Yes. A huge part of their story is unlocking the Western Canadian Sedimentary Basin, the WCSB. Reading through the earnings call, you can really sense that the tone from both the federal and provincial governments is shifting. They're being much more supportive of responsible infrastructure development.
What's fascinating here is the domino effect of egress.
Break that down for us.
Egress simply refers to the ability to get extracted products out of a geographically constrained basin. For decades, Western Canada has been notoriously bottlenecked.
Right, getting the product to the coast has always been the issue.
Exactly. But now, massive export projects like LNG Canada and Pembina's own Cedar LNG are finally coming online.
And to run those massive LNG export facilities on the coast, you need to feed them incredible amounts of natural gas from the basin.
That is where the dominoes start falling. When producers drill to extract that natural gas for export, they also produce a liquid byproduct called condensate.
Oh.
And it just so happens that condensate is desperately needed right next door by the oil sands operators.
Because they use it as a diluent. Right.
Right. They use it to thin out heavy crude oil so it can actually flow through the pipelines down to the refineries. So, as the export gates open for natural gas, it unleashes a massive flood of condensate that also needs to be processed and transported.
Ah, I see.
Pembina is perfectly positioned to cross that entire value churn to catch every single one of those dominoes.
Which explains why they are aggressively sanctioning new pipeline projects right now to handle this exact growth. I always find it fascinating to look at the actual blueprints of these investments.
They got a lot going on.
They just announced the Birch-Taylor expansion. That is a CAD 310 million disaster investment for a 95-kilometer pipeline. It'll add 120,000 barrels per day of capacity right in that high-growth Montney region.
And they're also proceeding with the Taylor to Gordondale expansion.
Yes, that one is really interesting structurally.
What I found particularly insightful from the Q&A portion of the earnings call was how management discussed their approach to this specific project. They had already secured the federal permits for the full, massive build-out.
Right.
But instead of spending all that capital at once, their engineering teams developed a capital-light initial scope.
For CAD 115 million?
Exactly. For $115 million, they are upgrading some pump stations and building just a 16-kilometer pipeline segment to meet the immediate needs of their customers.
So they retain the regulatory flexibility to build the rest of the pipeline later, but only when the market demand actually arrives.
Exactly.
We have the permits, but let's not spend all our money at once strategy. Very prudent, as they joked on the call.
Very prudent.
Add to that the previously announced Fox Creek to Namao expansion, which is another CAD 200 million for 70,000 barrels per day. And you have over CAD 600 million in conventional pipe being laid down just to handle this basin unlocking.
This capital spending is directly tied to financial security. Midstream companies fundamentally despise risk. They do not build these massive expansions on speculation.
Never build it and hope they come.
Never. In 2025 alone, Pembina renewed existing contracts or executed brand new ones for over 200,000 barrels per day of capacity. A prime example of this strategy is the Nipisi pipeline.
Oh, Right.
They reactivated it back in 2023, specifically to serve the booming Clearwater heavy oil play. Today, it is fully contracted and generating 50% more EBITDA now than it did in its former service.
What blew me away looking at the commercial updates was the major deal with Tourmaline. They renewed 270 million cubic feet per day of gas processing, plus transportation and fractionation.
It's a massive deal.
When you were listening to this is why these seemingly dry contract details matter. It proves that these infrastructure giants aren't just laying steel in the mud and crossing their fingers hoping producers will use it. They are building strictly on demand to support highly specific, pre-contracted global economic shifts. They are essentially creating the physical supply chain for contracts that are already signed and sealed.
That is a crucial takeaway for anyone analyzing this sector. The infrastructure follows the secured commercial demand, not the other way around.
Yeah.
The risk is mitigated before the first shovel hits the dirt.
Okay, here's where it gets really interesting. We've spent time talking at traditional pipes and traditional liquids, but Pembina is moving way beyond just moving products from point A to point B.
They are expanding their horizon.
Let's pivot to their mega projects, starting with Cedar LNG. In the Q4 update, they noted the floating LNG vessel is currently over 35% complete.
Cedar LNG is turning out to be a masterclass in strategic de-risking. They had 1.5 million tons per annum of capacity that they needed to remarket. During the quarter, they successfully signed long-term tolling agreements for all of it. 1.0 million tons went to Petronas, which is a massive global LNG heavyweight.
And the rest.
The remaining 0.5 went to Ovintiv, a major producer right there in the Montney play.
The financial structure of that remarketing is brilliant. By locking in these long-term agreements, they actually increased Pembina's expected financial contribution from the project by 10%.
And more importantly, they secured that financial increase without exposing themselves to commodity price downside risks.
Because it's a tolling agreement.
Exactly. They are essentially collecting a fixed toll for the liquefaction service itself. They are capitalizing on the Canadian West Coast's massive geographic advantage.
Shorter shipping routes to Asia?
Right. Significantly shorter shipping distances to premium Asian markets compared to the U.S. Gulf Coast. They don't have to worry about the price of gas in Tokyo. They just get paid to freeze it and load it onto the ship.
But LNG isn't even their only major pivot. This next part is what really caught my eye. Let's talk about the Greenlight Electricity Centre.
This is a huge development.
Pembina, along with their partner Kineticor, is developing a massive gas-to-power project. They've already secured a 907-megawatt power grid allocation in Alberta. Yeah.
They sold land to a potential customer referred to very specifically on the call as an innovation center, which we all know is basically industry code for a massive AI data center.
It's the worst kept secret in the sector.
And they've already secured the availability of 2 massive turbines to generate the power.
If we connect this to the bigger picture, the genius of the Greenlight project becomes apparent. This isn't just a random pivot by a pipeline company into the electricity business.
Right.
It is a highly strategic, localized extension of their existing value chain. Think about the macro trends right now. A massive AI data center requires an unbelievable amount of continuous, reliable electricity.
24/7 power.
Exactly. By building the power plant to supply that electricity, Pembina is creating massive new localized demand for the very natural gas they already transport through their existing pipeline networks.
They transport the gas, they process the gas, and now they are vertically integrating by turning that gas into electricity to power the data centers.
That's brilliant. On the call, they mentioned Greenlight would consume roughly 75% of the gas volume that the entire Cedar LNG export facility will use. That is a staggering amount of localized demand.
It really is. As their CFO pointed out during the presentation, this strategy takes what looks like a higher-risk greenfield project, building a massive power plant from scratch, and turns it into a highly integrated, brownfield-like return profile.
Because the supply chain is a known quantity to them.
Because they control the feedstock supply chain, yes. The integration dramatically lowers the risk. They are targeting a final investment decision on Greenlight in the first half of 2026.
And keeping with the theme of these massive multi-billion-dollar mega projects, we should briefly touch on Dow's Path to Zero project.
Yes, the Fort Saskatchewan project.
Right. It's an integrated ethylene cracker being built there. While Dow revised their timeline slightly during the quarter, pushing the Phase 1 startup to late 2029, Pembina is still locked in to supply up to 50,000 barrels per day of ethane for it.
And that delay isn't necessarily a bad thing for them.
No, the delay actually gives Pembina time to evaluate the most capital-efficient way to build that infrastructure, with their own final investment decision expected in 2026.
It is another perfect example of the domino effect we discussed earlier, just in a different sector.
Yeah.
A localized petrochemical expansion in Alberta ripples backward, creating guaranteed long-term demand for the extraction, processing, and transportation services that Pembina provides.
So what does this all mean for you as you process all this? When you step back and look at this full picture, Pembina is really functioning as the vital circulatory system for North American energy.
That's a great way to put it.
They are seamlessly bridging traditional oil and gas transportation with future-focused LNG exports to Asia, and simultaneously preparing to meet the massive new electricity demands of tech innovation centers right in their own backyard. They're at the center of several massive macro trends.
That is a very accurate assessment of their strategic positioning, but it is also vital that we balance this view with the very real risks they are navigating daily.
Right, it's not all perfectly smooth sailing.
The Q4 earnings call made it clear that this isn't a frictionless environment. They are constantly dealing with market volatility. We saw how something as unpredictable as extreme weather driving up gas prices in Chicago can directly squeeze their marketing margins and impact the bottom line.
Yeah, that Chicago weather event was a real wild card.
Furthermore, projects like Greenlight and the major pipeline expansions rely heavily on third parties actually pulling the trigger.
Yes.
Pembina can build the power plant, but they don't control if their tech customer ultimately decides to take final investment decision on their own AI data center.
That is a great point. They are holding their critical piece of the puzzle, but they still need the other players to snap their pieces in for the whole picture to come together.
Exactly.
But the key takeaway for you listening to this should be the sheer adaptability of modern infrastructure companies.
Absolutely.
The days of just laying a steel pipe in the ground, collecting a toll, and walking away, those days are completely over.
Long gone.
Companies like Pembina are actively orchestrating complex global supply chains. They are connecting the dots from premium Asian LNG markets to localized tech data centers in Alberta, and they are engineering these brilliant capital-light solutions to navigate the financial bumps in between.
They are managing complexity on a scale that is truly remarkable. They are balancing billion-dollar capital allocations across different commodities, vastly different geographies, and different decades of projected demand.
All while trying to satisfy the immediate quarterly demands of Wall Street.
Which is never easy.
No, it isn't. Well, thank you so much for joining us for this deep dive. We really hope that you are walking away feeling thoroughly equipped with some real aha moments about the mechanics of the energy sector.
There's a lot of data to digest, but it's important.
It's a rapidly evolving world, and understanding the physical infrastructure underneath it all gives you a massive analytical advantage, whether you are heading into a boardroom or just trying to understand the headlines.
This raises an important question to leave you with.
Lay it on us.
We've seen how a midstream company is vertically integrating to capture massive new demand. If traditional pipeline companies are increasingly the ones building the power infrastructure for the next generation of tech and AI data centers, while simultaneously controlling the physical export gateways for global fuel, at what point do these middlemen actually become the primary architects of the global economy?
Wow.
It's something for you to mull over the next time you flip a light switch or read a headline about the latest AI development.
What a great, provocative thought to end on. It really flips the script on who holds the power in the modern economy. Thanks for listening, and we will see you on the next Deep Dive.